wanted to just touch on a couple things, anticipating some questions out of Joe's presentation as well. So for 2014, we feel really good about the rollout, the upcoming rollout on a regional basis and then on a full-time basis of the TR90 program. That is obviously going to be a huge catalyst to 2014 growth. Joe also showed the slide of the anticipated LTO of True Face Essence Ultra in China. That is also going to be a real catalyst for growth in China. The forecasts coming out of the market for that product launch are substantial. Looking beyond 2014, and in fact at this slide, you'll see that we've bracketed the first 4 categories on the future category side of this slide as being available in 2015. All of those concepts are in development and in various stages of development, and we do want to be ready to launch any of them in 2015. Highly likely, almost certain that we will launch the next generation nutrition, the ageLOC Alpha product that Joe explained, the MOAS product, the mother of all supplements. This is the one that's been in development for years. The other products that we'll launch are going to depend upon local market conditions and business conditions and where we are at that moment in time, but we want to be ready on all of them. Now, we have not released, for your takeaway, a photograph of the ageLOC Bespoke product, the personalized skincare product, just for competitive reasons. We've been working for years with one of the top industrial design firms in the world, a London-based firm, to develop that product, and it's not easy. And so we wanted to share with you the notion of and the vision of a countertop sleek device that incorporates disposable cartridges that are chosen based on your particular skincare needs, that are replaced on a monthly basis. This is not an easy machine to build, and in fact the ingredients are mixed in the device instead of being pre-mixed, which has a lot of hygienic benefits. So instead of one of the concepts that's just testing really well in our consumer focus group tests is that today, as soon as you open a jar of any skin cream and stick your fingers in it, it's contaminated. Whereas in our device, we'll be mixing fresh each time skincare products are used, the products that you're applying to yourself topically. So we're really excited about that concept. It's very new and testing very strong in our focus group tests, as are the other concepts. We have a huge franchise in the Galvanic Spa, $500 million a year currently. People are taught to use that device twice a week. And we think there's a real opportunity for us to complement our Galvanic Spa franchise with a daily use device that will be very, very compelling. All right, so with that, we're going to turn it over to Rich to get us to the finish line here on the presentation.
All righty. Some of you have asked if I'm still conservative or not after our guidance this morning. We haven't done 25% guidance in the past. I've used the same exact metrics and methodology this year that I've used every single year, trying to look at where our sales leaders and active base are growing, trying to look at what the LTO looks like, trying to look at growth rates market by market. And as we do every single year, I'll give you my model. It's right here. We'll walk you through how we get to the $4 billion and $7.50 in earnings per share. You can see for yourself and try and evaluate where there's conservatism, where we're being a little aggressive, where we have room to play one way or other, and then you can come up with your own models from there. Our focus is truly to create long-term shareholder value. Well, I think we come across probably as a pretty conservative management team, but we hope as we sit down with investors that they see we've got our war paint on, that we're ready to go to battle, that we're doing everything we can to create meaningful long-term shareholder value. Here's our guidance. $3.9 to $4 billion in revenue. That's a 25% growth rate approximately over last year. Operating margin slightly increasing. Some of you may say, wait a minute, you've increased operating margin 100 basis points at least every year for the last 6 or 7 years. Why are you projecting 10 to 30 basis points? This is simply it. We are building a budget to support a growth rate faster than what we are identifying here in our growth. So if we scale past $4 billion, as we have in the past few years, scaling past our guidance, this is conservative. We will be higher than 17.3%. But we try and make sure we're trying to scale to support that increasing growth rate that we've experienced in the last few years. And earnings per share then fall out at $7.25 to $7.50. That's a 25 to 30% growth rate over our guidance for this year. I'm going to walk you through trying to project out future revenue. The best metric we can look to is what we've been doing in the past. So we'll walk through these one at a time. Here's our overall growth rate. Last three-year CAGR is a 28% growth rate. So our 25 to 28% growth rate we've guided to on a constant currency basis remains consistent with where we've been the last 3 years. And then let's break it down region by region, and then I'll give you our growth rates that we're projecting region by region. Greater China growth over the last 3 years, 74%, but that's greatly influenced by what's happened in the last 12 months. And so projecting China will continue to give forecasts and projections based on conservatism in 2 areas. As I stated this last year, I think I stated it the year before. Number 1, the size of our LTO, and number 2, what's happening in our emerging markets, and specifically mainland China. You can see our China growth over the last 3 years. Mainland is up 122%, will be approximately $1 billion this year in mainland China, and we've dialed that down for next year, not because necessarily we see metrics changing right now, but because we believe it's prudent on a larger base to dial down our growth rate a little bit in our guidance. Okay, here's North Asia. Korea, our all-star market, consistently growing at a 25% rate. Our 3-year CAGR remains at approximately 28%. We're proud of the fact that we've been able to level Japan off. You see, after a long decline, we've been able to level that thing off, but we are not projecting growth for next year. We're projecting Japan to remain about even with where it is this year. We are encouraged by some signs that we're seeing there. We have not built in any growth right now into the forecast, although our Japan management team really believes they can continue to see that market turn in the right direction. Southeast Asia, another very consistent grower, 28-29% over the last 3 and 5 years. Steady growth again this year, successful LTO, growth spread out all over the region. Every single market is experiencing growth, and you can kind of see by this pie chart the spread and distribution of our revenue over those various markets. Latin America is something we talked about last year, right? We talked about developing a new model, looking to expand our business in Latin America. We have put that on hold to a certain extent right now because of what is happening in our current business. Look at that over the last couple of years. We've doubled the size of our business in the last 2 years. We've got some good traction happening. So we've, to not distract from that, we put other plans on hold right now to drive growth in our current model going forth in Latin America. We like what's happening there. There's some good things happening. And the North America remains steady as well. We're very encouraged, actually, by what we saw with the LTO in North America. So for the first time, after continuing to refine this process, we got real traction in North America with active growth coming out of the LTO. And we're hoping that that will continue to sustain. If so, I think our guidance for North America is probably fairly cautious for next year. But we really like what happened with the LTO. It's by far our most successful LTO here in this region. And then Europe, which makes up just 5% of our revenue, another steady grower. We have had some difficulty there, particularly in Eastern Europe and a little bit of slowing in Northern Europe. Our Western Europe, which is the largest portion of the business, continues to be very healthy, and we believe Europe has great potential going forward. Also, very good success coming out of the LTO in October with Europe. Here's what it looks like then for our guidance going forward. So you can compare what our 3-year experience is, try and factor in where we're guiding to, and then analyze where we're trying to be conservative and not. So Greater China, 50 to 55% growth. That is certainly a dial down from where we were this year. This year we added approximately $700 million in revenue growth from last year to this year, and our guidance for next year to 2014 essentially represents about $700 million of growth coming out of that region. So consistent in dollars, certainly a smaller amount in terms of our growth rate. North Asia, 4 to 6%. This reflects a flat rate in Japan with growth in Korea of about 10 to 12%. This is also a conservative number, we believe, with Korea. Korea is influenced by a very solid LTO this year, and so wrapping up around that, I've been a little conservative in giving that guidance. I've guided to 10 to 12%. That's likely an area where we could see a little bit of upside. South Asia Pacific, 18 to 22%, is fairly consistent with what they've been doing the last couple of years. Those markets look good. They look healthy. The underlying dynamics of active growth as well as sales leaders growth is very solid, so we expect those markets to continue to perform well. The Americas at 6 to 9% growth includes obviously continued solid growth in Latin America, with North America growing about 5%. This is also a fairly conservative growth rate if, in fact, the dynamic of seeing active-based growth continues. If that continues, we'll be able to grow beyond this as well. But this is fairly consistent with what we've seen in the Americas over the last 3 to 4 years. And then Europe growth of 5 to 8%. You add all this up, it's a 25 to 28% local currency growth rate with a 3% negative currency influence. So it's about $120 million we're taking off the top line for currency next year. Let me walk you through what that looks like region by region. So this is quite a change, by the way, over where it's been the last several years. If you go back to when I started 11 years ago, if you can imagine, I've been doing this crazy job for 11 years, like 70 years in dog years. Feels like that some days. It used to be that green bar was the Japanese yen, right? And now it's shifted over to only being 10% of our business. 55% of our business is tied to the U.S. dollar if you count China being tied to the U.S. dollar. So we don't see quite the impact when currencies fluctuate, because obviously our U.S. business, the China business, Hong Kong business, which are tied to the U.S. dollar, don't fluctuate very much. 30% of our business, these currencies kind of move together. They're the Southeast Asia, Taiwan currencies, and we've guided the Korean won, which is the biggest of that group, at 1,100. That's the rate we're using for next year. It's currently trading around 1065, so this could be a little bit of conservatism there. The Japanese yen, 10% of our business, we've guided to 102. That's what we modeled it out. That may actually not be conservative. There's some banks forecasting that the yen will go to 105 to 108 next year. But we're slightly weaker than where it's at today, trading at just over 100. And then the euro, which is 5% of our business, we've modeled at about 0.78, and it's currently tracking at about 0.75, or just a little stronger than that today. That's how we get to our revenue number. That's our $4 billion. You guys can evaluate if that's conservative or not. We think we can do this. We feel very comfortable with our guidance, and it's going to be a great year. By all accounts, it's going to be a great year next year. Okay, as it relates to the quarterly guidance as well as the LTO, we've modeled $600 million of LTO volume. We are building inventory for much more than $600 million. Our forecasts in the markets are bigger than $600 million. But at the end of the day, we haven't done this before. We've done 550. That's our biggest one, so we'll kind of guide slightly ahead of that for next year. And most of this LTO is going to happen in the second and third quarters. So we're still refining just a little bit the exact dates of when the markets launch. I've only got 10% of this LTO in the first quarter number, so somewhere around $60 to $70 million in the first quarter. Probably Korea and Japan, if those two markets go in the first quarter. I've tried to calibrate for you where I'm looking at first quarter revenue right now. So that'll help you kind of calibrate the rest of the year. We have more difficult comps, obviously, in Q2 and Q3 next year, because that's when the LTO happened in 2013. First quarter and second quarter, we've got fairly easy comparisons because we had no LTO in 2012 in those quarters. So $850 to $870 million. with a operating margin somewhere around 16% in the first quarter. That puts our EPS around $1.45 in the first quarter, and then obviously building for there. The LTO quarters, we're going to have a lot higher operating margin, and overall, again, we got it to about a 17.3% operating margin. So how do we continue to sustain growth and drive shareholder value, and walk you through kind of the line items of our income statement here? Number one, we believe our most important thing to do right now is continue to drive top-line growth and sustain that ability to grow at a high level of rate. We believe that has more benefit to shareholders than trying to save a dollar here, a dollar there. So we are investing back in the future in a number of different ways, frankly, at a pace that we've never done in the past, at least not in the last 11 years that I'm familiar with. We're investing in our global sales initiatives. We're investing in our product discovery and development. In fact, we've more than doubled our budget in the last 24 months as it relates to product discovery and development expenses. Channel innovation. Dan talked about a few of those, the expos, things like that. We'll have about $20 million invested in these initiatives, new initiatives, trying to expand those initiatives to continue to drive growth throughout the world next year. And then we are investing in our infrastructure. We'll actually add a new Korea headquarters next year. It'll be a leased space, so the CapEx is much smaller, but we're continuing to expand our headquarters around the world. And Korea is our next year's project, and continued expansion in China. There's our operating margin, 17.1 to 17.3. Let's just break it down real quick. Here's our gross margin. We expect it to remain fairly consistent with where it's at today. We have good gross margins on each of the products we're launching, as well as the one Joe talked about. By the way, those all have great margins. So every product that we have in the pipeline has to fit our model, and these certainly fit our model going forward. So maintaining a strong sort of gross margin in the 84% range is something we feel we can continue to do. Selling expenses will be high next year. If our growth rate is 25%, our selling expenses are going to be high. We're obviously going to be able to make that up on our overhead leverage, but our selling expenses will remain in the 47.3 to 47.8% range based on this guidance. Let me just highlight those three things that are driving this number higher than it's been in the past. Number one, LTO revenue pushes the average group volume for every one of our executives higher, which pays out at a little bit higher commission rate. So it pushes our overall rate up just a little bit. Secondly, Dan showed you a perfect vision or picture of why our qualifiers for incentive trips is going up. We have more and more people qualifying. Guess what? It means our retention rates are going higher. Those are great things, but it's costing some money to train and recognize and reward the efforts of these leaders. Those expenses are a little bit higher. That's pushing our rate up. And then finally, we have special regional achievement bonuses, like our $1 billion achievement in Greater China. We have those spread now throughout the world. It accounts for approximately 1% of sales, but it's something that as we've grown and started to achieve these numbers, we're accruing some expense related to that. Our G&A at approximately 19%. Truman mentioned we went through a significant transformation back in 2006 and 2007. We continue to hold that discipline as we go forward, making sure that we're leveraging our ability to make ourselves very profitable going forward. We feel good about this. We feel like we're running lean, but at the same time investing in areas that will continue to sustain growth going forward. About half of our overhead costs are fixed, so we're able to leverage those on a higher revenue growth. We'll continue to invest, as I mentioned, approximately $20 million next year in channel innovation. We've got a doubling of our budget in the product discovery and development to support the initiatives Joe talked about. Those will be well worth the dollars we spend in that area. It will drive significant growth in the future. And then just to note that with our Greater China headquarters, as well as our headquarters in Provo, we put a lot of money in CapEx in the last couple of years. And next year will be another high CapEx year as we expand in China. But the expense in our G&A will move a little bit towards depreciation as opposed to lease costs, things like that. So there'll be a little bit of a cash flow implication. I have not modeled any net interest expense into the model next year because our cash balances would generate interest income that will offset our interest expense as our debt level continues to go down. No foreign currency impact on our debt. That's primarily the yen, and because we're modeling the yen essentially where it's at today, there's not an impact from that. And finally, I've been very conservative. I know this question's going to come up. How come we're not modeling more share repurchase? I've been very conservative. This is another area where we believe there's probably room we can get more aggressive and buy back more shares. Our expected tax rate will be 34 to 34.3%. This includes us permanently reinvesting approximately $80 million in Greater China. So taking the capital expenses that we've got planned for Greater China and about 2/3 of those treating as permanently reinvested dollars. That'll bring our tax rate down to around 34 to 34.3%. The majority of our cash we'll continue to do with the same thing we've done in the last years. We'll bring it back, pay dividends, we'll buy back stock, but because we're bringing it back here, we don't get the tax benefit necessarily on some of our foreign earnings that are taxed at a lower rate. There's earnings per share, $7.25 to $7.50. Our cash modeling is self-explanatory for the most part. Let me just highlight our capital expense, $170 to $200 million. 120 of this is targeted for China. So primarily manufacturing expansion, store expansion, and some other minor things, equipment, infrastructure, things like that. We have about $15 to $20 million targeted for Korea, where we're going to expand a new headquarters there. We've got quite a bit targeted towards CRM initiatives, which we really believe will help us get better and better at retaining and keeping our customers as well as our sales leaders. Debt payments of only about $30 million. And then dividend payment is something that the board will determine. Generally, we do that at the first of the year, but we consistently raise our dividend, and at least we have in the past. Cash from operations estimating around $500 million next year. There's our dividend history. Again, that will be reviewed with our board of directors and determined at the first of the year. But we've consistently raised our dividend ever since we launched it. Stock repurchase. This is our history, so the best predictor of what we're going to do in the future is look at what we've done in the past. $65 million a year on average, 2.5 million shares, and this is through 2012, an average stock price of $25.99. It makes us look very smart, but what we do is consistently execute every single year and using our cash to buy our shares back. This year so far, we've spent $90.8 million up through the end of Q3 buying back our stock, an average price of $71, and that's about 1.27 million shares. Very consistent, about 2% of our outstanding shares repurchased, and that was prior to our Q4 here. We believe, Truman mentioned this, alluded to this, the importance of aligning everybody in the company and outside of our company to move together as we try and accomplish our vision and objectives here. Our board has been very supportive of management incentives that have aligned the group. When we first went through transformation, the alignment was really to get everybody on the same page to reduce cost. That was the primary focus. We achieved that goal. The next incentive was really about trying to start driving future growth, and that is reflective in this latest incentive that we've done. Let me just show you, and by the way, from a CFO standpoint, this makes my job so much easier. It's a ground-up budgeting process where all the markets submit their 5-year budgets. The $10 billion number is not something we just pulled out of the air. This is a budget that came from all the markets, and they commit to it. And then we put an incentive attached to it so that we're all accountable for each other, but there's upside if we deliver on these numbers. The budgeting process is very easy because every single person is incented in the same way, and it makes our process very, very effective as we go forward. It used to be that we are always fighting to get costs down and revenue up. Now the revenue comes way higher than what we ever forecasted it to be, and the costs are always in line as our markets are motivated to achieve these incentives. There was our first incentive at the end of 2007, going from 84 cents to $2. We achieved that. By the way, we had to do it in 5 years. We achieved that ahead of schedule. We put forward, at that point in time, our next incentive, which was to go to $4 per share, so a doubling of the EPS, and we achieved that one this year ahead of schedule as well. And finally, In the last quarter, our board has authorized then our next incentive, taking us from $4 a share going forward with a benchmark at $6, a quarter of the shares vesting at $6, a quarter at $8, and $10 and $12. We have to achieve $12 per share by 2019 in order for these options to vest. Again, we have about 200 of our managers, 250 of our managers around the world that participate in this incentive. It's done an amazing job at aligning us around common shareholder objectives. The future looks really, really good for us. We're excited about it. The business is very solid. We love the way we came through our convention. We love the way our executive count continues to grow even after the LTO. That's a very encouraging sign for us because it indicates longer-term growth as we go forward. And we think we'll be able to sustain this rapid growth that we've seen over the last little while. Truman.
All right, then. How does Nu Skin sustain rapid growth? Well, we do it by relying on all of the things that have gotten us to this point that we've talked about this morning. And even more specifically here, going forward in the short term, we do it by continuing to improve our execution, by executing strong LTOs in 2014, by expanding the Expo concept that Dan talked about. And I hope we're also leaving you with confidence that the ammunition we have in our product pipeline is compelling, because we certainly think that it is. And we really feel good about the ammunition we have to use in that regard.